How might the Biden infrastructure plan impact the U.S. economy that is finally showing signs of life again? Well, Zach's chief equity strategist and economist, John Blank, hopefully has that answer for us. John, you say this is more challenging than it sounds. Has this plan already been priced in?
Well, Terry, I'm looking at the New York Times big blow up of this whole story. The infrastructure plan they put forward is 2.3 trillion. You have to keep that number over 8 or 10 years. So the number would be 200 to 300 billion a year for 8 or 10 years on a $26 trillion economy. The American Families Plan, which he talked about last night, is another 1.8 trillion, but again over a number of years, I expect. So this whole thing, 4.1 trillion on a $26 trillion economy. It's 15% in an annual basis, probably a quarter of that over longer periods of time. So what you get is, let's throw out a 3% of GDP number on an annual basis. And the flip side of this, of course, will be the taxation, but you have to find an additional 3% of GDP. And so what they're selling us on is that that's going to hit mainly rich people. And that's been the pitch, frankly, for instance, before the election. So none of this should be new news. The thing I look at that's just amazing, though, is I counted 48 different segments of this chart. And the other thing to note here is the infrastructure plan, that 2.3 trillion, includes 400 billion for in-home care, which is basically care for people with disabilities and older adults. 400 billion, that's really not infrastructure, and it should be on the American family side. So in truth, the infrastructure plan is 1.9 trillion, and the families plan is really 2.2 trillion. Now, even if you go even further through the infrastructure plan, you get even more stuff that doesn't seem to make any sense from an infrastructure perspective. For example, HBCU, historically black colleges and universities. This is typically education, and it's on the infrastructure plan. And this goes on through National Science Foundation, which is a big thing, but that's pretty much education. And, again, a lot of this stuff, underserved communities, what is that? Community colleges, which is clearly education. So I would say that the biggest thing you can see here is that the infrastructure plan is substantially less than 1.9 trillion over 10 years. It's probably 1.5 trillion. And the real sop up is this incredible amount of support for in-home care, for education, for child and family support, and for tax credits to all of the above. That this is where the American Families Plan is really another part of the story, Terry.
All right. Well, the Fed met this week as well. Is the Fed going to remain a critical component to our economic recovery for the rest of this year?
Well, the Fed, as long as Powell continues to say what he's saying, which is he's going to stay out of the way, and frankly continue with this mortgage-backed and treasury bond finance, even in the face of a housing bubble, which is what he's saying, yeah, it's going to stay out of the way. The real issue here, though, is the second part of my statement, which is when does Powell recognize there's a housing bubble, and when does he pull back on the treasury mortgage-backed buying? That would be the first step to having the Fed play a role in taking the stock market down.
Yeah, so I mean, some are saying now that Fed QE is not doing much to help the economy, so increased pressure is on the Fed to taper that QE.
That's it. Then once he starts tapering it, then that takes the housing market down, which frankly would be, I think good, but for whatever reason, he continues to ignore the housing market price bubble. And I just think there's enough people on the Fed board and in the Fed regions that are going to start to tell him to take that seriously.
What about the threat of, and everybody's talking about it, increased inflation? We see it especially with grocery prices. It's now being viewed as the next biggest risk after the pandemic.
Yeah, I mean, inflation, again, year-on-year comps are certainly a problem here because, the shutdown happened last year from about March through July. And so we're going to have poor comps for at least a few more months, which will be written off by the market. But beyond that, there's certainly huge inflation in housing and materials and commodities, it's not incorporated because it's the consumer price inflation rate, which incorporates as much more stable purchases. So I think it's really a misclassification that allows the Fed to escape its statutory mandate that it doesn't really address the bubbles it has created and the price acceleration that is seeing out in the economy. And as long as they're moving off a 4 or 5 decade old CPI computation, they can escape that charge, and that's what they're doing.
We keep hearing about the Biden tax increase proposed on the wealthiest Americans. We're talking about the top of the top there. What economic impact would that increase have on those wealthiest Americans and on the economy?
The basic thing is probably positive. I mean, the thing that is basically not discussed, but I'll throw it out there, is that when people get that wealthy, they just hoard wealth. They don't really spend it. They don't need to spend it. And so the hoarding slows the growth rate down because the wealth is just piled up. And so taxing it and putting it back into lower income parts of the economy who have a higher propensity to spend out of that income is pro-growth. So I do think if it's handled properly, which is a really big caveat, Terry, it's probably pro-growth.
So against this background, are you bullish then on the U.S. economy as a whole, or are you still concerned about certain segments of it?
I think you have to be bullish on the U.S. economy based nothing more than on vaccination rates in the United States going up, and including, we're at 28 or so percent of vaccination, fully vaccinated, probably another 8 or 10% that have caught the COVID. So we're probably at 40 to 50% of herd immunity. So as long as we can get that continuing to go up and get to herd immunity so we can get rid of the virus as a story in the United States, we're going to tackle this. Because really, at the end of the day, it's the virus eradication that will create the mobility that will drive the growth.
I think you mentioned GDP earlier in our conversation, but at this point, what are you projecting for GDP for the year?
Well, Terry, this is an irrelevant number at this point because of the year-on-year comp issue we've talked about. And I think what people should try to do is pay attention to when we crest above the previous high of GDP, which is actually happening pretty quickly. And when we crest that previous high is when you're going to see the potential for a lot of macroeconomic forces hit the U.S. economy. And that's where people should focus on.
All right, here are a few stocks on your radar now: ExxonMobil, Chevron, and Deere and Company.
Yeah, let's talk ExxonMobil. I mean, fascinating story here. $250 billion market cap company, trading at around $58 a share. Before this whole thing back in 2019, this was an $80 a share stock. It started tanking in the 2019-2020 period, and it went to 70. So it's got about $10 more a share to go back to the pre-pandemic levels, but the trend of the stock going back 5 or 6 more years, even to 90 to 80 to 70, now to 60, is down. And this is the move away from fossil fuels and the carbon issue, climate change, and all of this. And this is another part of the Biden package with John Kerry leading the initiative, the former Secretary of State. This is clearly impacting ExxonMobil. There is a bull case, though, and it's a strong one, which is why it's number one ranked stock, is the global economy gets vaccination underway. We just saw today that European vaccination rates are exceeding the US for the first time. If this hits Japan and China and other parts of the world, then oil demand goes up and ExxonMobil stock goes up because OPEC starts to get, if they start to let more oil go, then everybody's production goes up, and some of the revenues here could be quite substantially for ExxonMobil. So the bull case here is the vaccination rates rise outside the U.S. and ExxonMobil gets a bid.
Okay, what about Chevron?
Chevron, same story. I mean, Chevron is their big competitor. They used to be the same company. There's really nothing more to talk about. They're going to track one another. Again, if you're going to look for a play here, just go with Exxon, not Chevron. They're basically the same.
And then Deere and Company.
Deere and Company. John Deere is an interesting story. This is a tractor company But in the midst of this whole marketplace, commodity prices, including a lot of ag prices, are going sky high. Soybeans, for example, has gone right through the roof. So what happens when farmers get money is they stop delaying their capex spending and their tractor spending as part of that. So Deere is a great bull stock for a commodity market, and that's where you should look at it. Issue here is, of course, you're not the first guy to think about this, and is it already priced in to the stock? And that probably is true.
And that's the latest on the economy and a couple of stocks, too. From our chief equity strategist and economist, John Blank. With John, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.